Hello, everyone. Thank you so much for joining us yet again on your Mortgage Monday Minute with Linda May Tomko, Home Financing Advisor with Scotia Bank. And who am I, do you ask? Well, I'm Alex Ward, broker owner of Maxwell Devonshire Realty, and we're here today to learn from the amazing Linda May as she talks to you about the difference between a 30-year amortization on the new home build announced by the federal government this past week versus what it was before when it was a typical 25-year amortization. So, Linda May, the floor is yours.
Hello, everyone. I hope everyone had a great weekend. Weekends seem to go really fast in our house. I just wanted to go over, I guess, the new changes that are taking effect in August. If you haven't heard, the changes are for first-time home buyers that are purchasing new builds. You can now do a 30-year amortization, which, may seem like, what does that even mean? But what it means is previously you were maxed out at 25 years. So your payment, whatever your payment was, couldn't adjust it or make it smaller. But now, effective August, you can take your amortization to 30 years for first-time home buyers and new builds. So it's not one or the other, it's actually together. So you need to be a first-time home buyer and you need to be purchasing a new build as it stands right now. We'll see what happens in the future. Maybe there's some updates to that. I don't know. But right now it has to be purchasing new and first-time home buyer. I just wanted to give some comparisons, and I'm going to work in round numbers. And I'm going to work in kind of 4 different price ranges just to show you the difference between the payments on a 25-year amortization and then a 30-year amortization, just to give you an idea of the difference in the payments. As well, when we're going through this, thinking about the difference in the qualifying rate. So when we are putting an application together, we have to qualify the application at whatever your rate is plus 2%. So right now, the rate that I've used for these comparisons is 4.85 because that is our rate on an insured mortgage at the moment, on a 3-year or a 5-year rate, actually. So that's the number that I've gone with. That rate may change in the future, and obviously your payment would adjust based on that, but these numbers are adjusted. I have not gone into detail with the comparison on the premiums because I really don't know if there's going to be an increase in premium on a 30-year amortization. We haven't got any information from the insurers about that yet. I'm assuming that we'll see some sort of an increase. Right now, when you're purchasing and putting 5% down, it's 4% that you're going to pay for the premium. So, for example, I'll just show you here. Whoops. On a 30 or $350,000 purchase. So if you were purchasing a property for $350,000, your minimum down payment would be $17,500. We're going to take that $17,500 off the top, and then we're going to add the premium, the insurance premium, onto that, which would be another $14,000. I'm just using round numbers because as a banker, I love round numbers. So, and I've just used, sorry, it says 3 and 5 year, but our rate is the same. So the payments will be the same. So the first option here is a 25-year amortization. Payments are $2,005.83. Now, for the same property at the same rate, if you do the 30-year amortization, your payment's $1,836.69, and these are monthly. Now, the direct comparison. So basically, what this does for you is it's going to allow you to qualify for possibly a little bit higher. Now, these payments that we have to qualify for the application, we have to qualify them at 6.85. So these payments are going to be higher, but I wanted to show you guys the actual payments that you would be making. Now, one of the tips that I recommend is qualifying at the 30-year amortization and then adjusting your payments once you have the mortgage funded to the 25 years. And then as long as you can afford to make those payments, then you're going to pay your mortgage off faster and you're going to save yourself the interest. Just to show you the 400, if we were to purchase at 400. So if you're purchasing at 400, your minimum down payment would be 20,000. We're going to minus that off the top, and then we're going to add the premium on there, which would be 16,000. Again, just working in round numbers, so 400,000. Payments are $2,292.38 on a 25-year amortization, and then $2,099.07 on a 30-year amortization. So you're saving yourself, just almost $200 for the 450 option. One sec here. So 450,000 purchase price, same rate, same details there, 25 years and 30-year. Our payments are $2,578.93 on a 25-year amortization, and then $2,361.46 on a 30-year amortization. So over 200 there. And for the 500 purchase price, we're at, 2868.48 and 2623.84. So these numbers will directly affect your qualifying. So when you're looking at purchasing into the summer months, these options for the 30-year amortization will be available to you. Once I have an update from the insurers as to what the premium looks like on a 30-year amortization, I will let you guys know as well. I would say it's going to be higher than the 4% that it currently is on the 25 years, but I didn't want to quote those numbers because I don't have solid information back on that. But as soon as I do, you guys will know. So that's that's kind of all I have today for, and apparently I have a frog in my throat. So
Yeah, and if you were trying to calculate what the difference in those payments are over the lifetime of the 5-year term, on the 350,000, it was roughly just over 10,000, and at the $500,000 mortgage, it's 14,450 bucks roughly. So that's pretty significant savings over that 5 years, even though it only feels like a $200 per month difference. It
right.
really does add up over that time. So yeah, this is potentially quite huge, and specifically on a qualification standpoint, though we never recommend to push yourself absolutely to the limit because things happen in life and you want to make sure you have some
Some
emergency
cushion for
savings
sure.
options in there. But even if you planned for the 25-year, did that and put the $200 away into a savings plan, then you could still have that money there for that emergency while still being able to afford.
Well, and keeping in mind too, like purchasing a new home, there's always expenses, right? So having that $200 extra per month can, maybe help you finish your basement, or maybe help you do a little bit of yard work, or plant those flowers or trees or whatever it is that you're looking at doing to beautify the property. Because when you purchase a new build, I mean, you and I both know that it's the build and sometimes the grass, right? And maybe a fence.
Yep. Yep.
So
So this is great news. Obviously, more information is going to come out because it doesn't really take effect until August. Plus, I believe the budget needs to still receive official assent or royal assent. But that was Linda. Ooh, that was Linda May Tomko, home financing advisor with Scotia Bank. I'm Alex Ward, your favorite broker owner of Maxwell Devonshire Realty, and we cannot wait to see you next week. See you, everyone.
have a good day, guys.